Welcome back to Startup Accounting 101. This is a video series for founders to understand accounting fundamentals for running a business. We're moving through the financial projections template, which is available for free from score.org. Just go to their template gallery and download the file. I'll have the link in the description below. So this video, we're covering tab 6B, which is the cash flow forecast for years 1 to 3. There is a note here to help make the forecast sort of easier to see the totals. So we have totals here for year 1, year 2, and all the way to the right is year 3. So here the note says to only view the annual total side by side, highlight columns C through N and right click, then select hide. Use the same procedure to hide columns P through AA. To show them again, highlight columns B, O, and AB, right click and select unhide. So what that means is when you highlight O through N, you can right click and hide. You can do the same thing here from P to AA and hide. That way it's easier to see the totals. Then when you need to, you can unhide, and then you can see the full month for year 2. Do the same thing for O and AB. You can unhide. What I like to do is to group the columns together so I can quickly hide and unhide with a click. So here I can click and then unclick. And how you do this, it's on the Data tab. And you would have to unprotect the sheet. So unprotect, put in the password, which is 1234. And once it is unprotected, then these are available. So you can highlight C through N, and then you can group and ungroup as you like. So here's a group there. And same thing for P to AA, ungroup, group. That way it is a simple click to sort of hide and unhide these columns. And once you have them hidden, you can use these numbers up here. 1 is everything's hidden. Then you can just click 2 and everything is unhidden. So these are just different ways that you can use to hide and unhide columns. Now, on to the cash flow forecast. In column B, we see the year 1 totals, and that comes from the prior tab. So the totals in column O, that is getting pulled into this forecast here. And if you notice, the beginning balance is about 48,000. That comes from the prior tab as well. That's the ending cash balance for December. And that is basically the same for every month. So whatever's the ending balance of the prior month is getting pushed out here. And it's the same for every month. So here we have ending cash is 32.5, beginning of February 32.5, and the same thing for every single month. So in this forecast, it's the same layout. So we have the cash inflows and cash outflows for the year, as well as the line of credit drawdown. And so because it's all the same, I'm just going to focus on the differences. Right. So first thing to look at is new fixed asset purchases. And this comes from additional inputs. The fixed assets here for the second and third year, it's just a total for the entire year. So in the forecast, it's basically this number divided by 12. So it's an even allocation of cash over the entire year. The template doesn't know exactly when I'll purchase equipment. So it could be that every year, October is when I want to upgrade or replace equipment for the business. So just kind of be mindful of that in the projection in real life. All of the cash could be hitting a particular month. But for now, even allocation is fine. It could be accruing or to make sure to set aside cash to make sure we can make a purchase whenever we need to for the year. Then we're moving on to additional inventory. So from year one, we already have 20K of inventory on hand. And this amount should actually cover my needs. So the cost of goods sold for the month, it should cover my preference for having a 1 month reserve to cover COGS. Pretty much all the way up until October, when we have that sort of spike in sales. So what I'll do is I'm going to add another 10,000 in September. And then I will hide year 2 to be able to look at year 3. And this template is cash expenditures. So it doesn't provide a running balance, running total. It should be cumulative, the way that the line of credit is cumulative. There's a line that keeps the overall balance. So with additional inventory, what I would have to do is I would have to add the numbers together to get the inventory that we have on hand by the end of year 2. COGS is constantly getting replenished. Like as we're producing, we're constantly buying inventory anyways, but it's just being used up. When people buy the candy bars, that's going with the customer. So by the end of year 2, we actually have 30,000 in raw materials on hand. And this is like additional surplus inventory on hand for production. And this number actually covers most of the year until, again, we reach that spike in production and sales for October. So for year 3, I'm going to choose to add 15,000 here. In September. Then operating activities, everything is the same as before in the prior cash flow. So we're going to move on to financing activities. And a note about owner's distribution and dividends paid. They're very, very similar. They are both ways for a business to pay out from the profits of the company. So the difference between these two categories are, depending on the type of company that you have, you'll typically use one or the other. So for owner's distribution, if you want to take an owner's draw, this is typically used for LLCs, partnerships, sole proprietors. You'll typically take a distribution out of the business. If you have a C Corp, dividends are paid out to shareholders. So in my template, I happen to have a C Corp here. I've assumed that I am a C Corp. So I would use dividends paid. If any additional profits was available for shareholders. Now, if I look at the ending cash balance, it's pretty close to 30,000, like the minimum that I need. And just FYI, the template here is pulling from the desired cash minimum, and that is being used for the entire forecast. Like, the template doesn't know that I'd prefer to have a 1 month minimum according to payroll. So year 2, the minimum should be about 55K, and year 3 should be 125. So that's a huge jump in my payroll monthly amount. And so what that means is that I would need to visually review the ending cash balance, and I'm going to have to make an assessment. And if I look at the drawdown amount, if I look at it for year 2, it's not that bad. It's only 13K here. Like, this is the total amount that I'm drawing from the line of credit, and most of it is in September, when ramping up for production, buying those additional inventory in September. So I can live with that. I can live with this. And the ending cash balance is about 90K, which is a healthy reserve going into year 3. When I look at the drawdown for year 3, though, I can see that I'm constantly drawing down on the line of credit for most of the year. And the line of credit balance keeps increasing. It's basically increasing to about 160K in September. And I mean, we do end the year with 125K in ending cash in the bank, which is pretty good. I will say that the template is idealistic in that the line of credit has no limit. There's no limit to the line of credit, and we could just draw down as much as we want, as much as we need, and we're just gonna pay that, was it 8%? We're just gonna pay 8% fee on whatever we borrow from the bank. So that's here, line of credit interest. In reality, that may not be the case. If you're working with a bank, they may have a limit on how much you can borrow based on a number of different factors. It could be based on, your sales, for the year. It could be the assets, based on the assets of the business. So if you have an asset-based loan, they'll be looking at the different assets that you have. Typically, it's AR and inventory, fixed goods together, and that could determine your borrowing limit. It's interesting that the cash flow forecast actually comes before the income statements in this template. By having to draw down against the line of credit every month, it tells me that the business is not profitable in year 3. And we should be able to see that in the income statements. And we'll have an opportunity to adjust several things, several assumptions that we have to make the business profitable. But for now, we have completed the cash flow forecast for years 1 to 3. The next videos coming out, we're going to be looking at those income statements. So like and comment if you enjoyed the video. Please subscribe, and thanks for watching.